Most business owners leave significant money on the table when they sell their company. And it's not because they negotiated poorly, it's because they didn't prepare early enough. I'm Andy Vandenberg, founder of VDB Wealth. Before starting my wealth management business, I bootstrapped a business and sold it to a private equity-backed firm. And prior to that, I spent years in private equity, which means I've now been on both sides of the table. I've seen business sales, and I can tell you, the owners who get the best outcomes aren't necessarily running the biggest companies. They're the ones who started preparing 3 to 5 years before they ever listed their business for sale. Today, I want to walk you through the checklist I give clients when they're thinking about an exit down the road. This isn't about tomorrow or next quarter. This is about the moves you make today that compound over the next few years and dramatically increase what you walk away with. Let's dive in. So why 3 to 5 years? Why don't you just hire a banker 6 months before you want to sell? Because buyers, whether they're private equity firms, strategic acquirers, or even individuals, they're looking at trends and not snapshots. They want to see consistent revenue growth, improving margins, diversified customers, and clean financials over multiple years. If you try to clean everything up 6 months before the sale, it looks like window dressing. But if EBITDA has grown steadily for 3 years, your customer concentration has decreased, your operations are running smoothly without you, that tells a completely different story. And that story commands a premium. The other reason is taxes. Some of the best tax strategies take years to set up properly. And if you wait until the year that you sell, you've missed the window. So let's talk about what you should actually be doing during this 3 to 5 year runway. The first thing, and this is absolutely foundational, is to get your financials and operations dialed in. I know this may sound obvious, but you'd be shocked how many business owners run personal expenses through the business, commingle funds, or just have inconsistent accounting practices. Here's what buyers are looking for: clean, audited financials. If you've been doing cash basis accounting, or if your books are a mess, start the transition to accrual accounting and consider getting a quality of earnings report done a year or two before the sale. This helps you identify issues before a buyer does. You may think you're being smart when you start paying for personal items through the business, but you have to remember that every dollar that reduces your profitability reduces your exit price by whatever your multiple is. So if you spend $100 of your business income on personal expenses, that could reduce your overall sale by $1,000 if you're selling for a 10 times multiple. Now let's talk about recurring revenue and predictability. Buyers will pay more for predictable cash flows. If your business is project-based or lumpy, think about how you can add recurring revenue streams or encourage repeat orders by the same customers. Even a small percentage of recurring revenue can meaningfully increase your multiple. Customer concentration. If one customer represents 30 or 40% of your revenue, that's a red flag. Buyers are going to discount your valuation or require holdbacks, escrows, earnouts to protect themselves. Start diversifying your customer base now. It takes time, but it's one of the highest ROI activities you can do pre-exit. There's a lot we can talk about around systems and processes. Buyers want to know that the business can run without you. If you're still the one closing every deal, managing key accounts, or putting out fires, that's a problem. Start documenting processes, building a strong management team, and stepping back from the day-to-day operations. The goal is to make yourself replaceable. I know it sounds strange, but that's what maximizes value. It may be challenging with your team, but we find that it actually supports them in being the best at their jobs. Now, not quite as sexy, but cleaning up your vendors and all your contracts. Go through all of your contracts. Are there any that are unfavorable, up for renewal soon, or have change of control clauses? It's better to clean those up early so they don't become negotiation points during due diligence. We find it's best to have a complete folder of every contract on the sales side as well as the vendor side. All of this takes time. Can't do it in 3 months, but if you start now, by the time you're ready to go to market, your business will be far more attractive and command a higher multiple. All right, let's talk taxes. This is where a lot of business owners either save a lot or leave a lot on the table. And the difference really just comes down to planning early. If you're currently structured as a C-corp, you need to think about double taxation. Some owners like to explore converting to an S-corp, but you need to be careful. There are certain tax rules that come up when converting to an S-corp, especially when it's in a similar time period to what you're selling. Generally, you want to wait at least 5 years after converting before selling to avoid any of these issues. So if you're thinking about it now, you should talk to your CPA about the best structure for your business. Better to do it now than 2 years from now. Now, I'm guessing everyone here has heard of qualified small business stock, QSBS. This is one of the most powerful tax breaks available if you qualify. So if you hold stock in a qualified C-corp for at least 5 years, you may be able to exclude up to $10 million in capital gains from your federal taxes, or 10 times your basis, whichever is greater. But here's the catch. Your company needs to be a C-corp, you need to hold the stock for 5 years, and the company has to be engaged in a qualified trade or business. Real estate and other service businesses don't qualify. However, if you do qualify, this is a huge planning opportunity. It requires 5 years of a holding period, so you need to set it up well in advance. The other thing to think about on the tax front is Can you sell via an installment or deferred comp method? Depending on the structure of your sale, you might be able to spread the tax hit over multiple years through an installment sale. You may also be able to negotiate deferred comp or earnouts that push income into future years when you may be in a lower tax bracket. I don't want to recommend these strategies because they're not right for everyone. Your situation entirely depends on your structure, your goals, and your timeline. I never like to let tax drive the actual strategy. My overall point here is if you start planning early, you have real time to start changing structures, time to improve your tax impact when you sell. I always advise working with a great CPA who's familiar with exits and a wealth manager who understands exit planning. The ROI on that is going to be massive. Now let's talk about valuation. Business sales are typically priced as a multiple of profitability, whether that's EBITDA or seller discretionary earnings. The question is, what determines whether you get a 4 times multiple or a 7 times multiple? A lot of it comes down to the factors we've already discussed: recurring revenue, customer diversification, financial cleanliness, but there are a few other levers worth mentioning. Buyers are paying for future cash flow, not past performance. If your revenue has been flat or declining, that's going to hurt your multiple. If you can show consistent growth, even if it's just modest growth, that signals opportunity and commands a premium. Focus on growth initiatives now, even if it means sacrificing some short-term profitability. Margin improvement is a big one. If your margins are improving year over year, that tells buyers you're getting more efficient and there's more leverage in the business. Look for ways to streamline operations, renegotiate vendor contracts, and even optimize pricing. Even a 2 to 3% margin improvement over a few years can translate to a meaningful increase in sale price. While it may seem high level, people want to know that you have a competitive moat. What makes your business defensible? Do you have technology, long-term contracts, a unique market position, or brand recognition? The stronger your moat is, the more buyers will pay. The hardest one to plan for is market timing. Industry trends matter a lot. If you're in a hot sector, say data centers right now, or healthcare services, you'll get a better multiple. So it's important to keep an eye on M&A activity in your industry. If deal volume is picking up and multiples are rising, that might signal a good time to go to market. And finally, here's something counterintuitive. It's worth investing in the business as you plan to sell it, even if it temporarily reduces EBITDA. If you're spending money to build infrastructure, hire key talent, or develop a new product that increases future growth potential, buyers will often look through that short-term hit and value the business on a normalized or forward-looking basis. The key is being intentional. Every decision you make in these 3 to 5 years should be viewed through the lens of, will this make my business more attractive to a buyer? And as you probably noticed with all the things I've shared today, what makes your business more attractive to a buyer is really just what makes your business a better business. And so you may plan to sell later into the future. All of these actions are going to make your business better. The final thing I want to talk about is how to build your wealth management team before you sell, not after. Here's what happens to a lot of business owners. They sell the company, they get a large check or an ACH, hit their account, and all of a sudden they're overwhelmed. They have massive amount of liquidity they've never had before. They're getting pitched by hundreds of different people, wealth managers, insurance salesmen, and they're making really big financial decisions under a lot of pressure without a clear plan and often confused about the tax impact. To me, that's not a good recipe for outcomes. It's far better to start building relationships early. You want to have a team in place that includes a wealth manager, financial planner who understands exits and help you model post-sale scenarios, what your tax bill will be, how do you want to maintain your lifestyle, what are your goals for this wealth, legacy, philanthropy, starting another business, a CPA with exit planning experience. And it's important to note, not all accountants specialize in this. So you want someone who's done this before and can be a strong member of the team with your attorney and banker. An estate planning attorney. Hopefully your wealth manager is incorporating this into the plan, but if you're receiving a significant windfall, you may want to think through an updated estate plan. That may include trusts, gifting strategies, or charitable vehicles. Don't wait until after the sale to think about this. A lot of people like to move their business into a trust when it's still privately owned, so that value of the business is outside of their estate. Some people also like to include attorneys and bankers as part of their team. It all depends on the size of the business and how important it is to bring in that. We always view it as a valuable way to get multiple bids and get a strong perspective on what your business should sell for. The benefit of assembling this team early is that they can pressure test your plans, identify gaps, ultimately help you avoid big costly mistakes. When you sell, you should have a strategy already in place and not starting to think about it. All right, let's recap. If you're a business owner thinking about an exit in the next 3 to 5 years, here's the checklist you need to follow. Clean up your financials and operations. Get your books in order. Try to reduce customer concentration, build system, and ultimately make the business less dependent on you. It's important to start tax planning now. Should you restructure your entity? Should you move things into trusts? Are you eligible for QSBS? Try to find a way to maximize your exit multiple, growing revenue, improving margins, strengthening your competitive position, and try to keep an eye on the market. See if there's a good opportunity to sell. And finally, build your wealth management team early. Get your advisors in place so you can go into the sale with a clear plan to avoid making reactive decisions. This isn't a sprint, it's a marathon. The business owners who treat their exit as a multi-year project rather than a one-time transaction are the ones who walk away with life-changing outcomes. If you're a business owner watching this and you're thinking, I should probably start working on some of this, I'd encourage you to take the first step. Even if you're not sure when you want to sell, starting the conversation now gives you options. At VDB Wealth, we work with business owners, tech employees, and hiring professionals who are navigating exactly these kinds of transitions. If you want to talk through your situation, whether that's exit planning, tax strategy, or just building a financial plan that gives you clarity, feel free to reach out. You can find our contact info in the description below. Thanks for watching. If you found this helpful, I'd appreciate if you'd like the video or subscribe to the channel. I'll put more content out like this on wealth building, tax strategy, and financial planning for high earners. Thanks again, and I'll see you in the next one.